There, first of all, I want to introduce myself. My name is Jeffrey Abraham, and over the last 4 to 5 years, I have become a loan modification specialist and also helped hundreds and hundreds of homeowners across the country stay in their homes, educate them, empower them. This class is free. You do not have to pay any money for it or anything like that. What we would like to do is go and do at least 2 classes a day to empower you and teach you exactly what a loan modification is, to explain you what the difference is in the different type of loan modifications with the HAMP program, the Home Affordable Modification Program, with the Home Affordable Refinance Program. That's for homeowners that would like to refinance their home. For the Home Affordable Unemployment Program, for the Home Affordable Foreclosure Alternative Program, that is help homeowners cash the keys to if they can't afford the house and they do have to foreclose. What a deed in lieu is, how you can just sign the house back over to the lender. And also we get into the last part of the classes. What is a short sale and how does it affect you, and how it could have some type of tax ramifications, but you have to always talk to an accountant about that, because I'm not an accountant. I'm a mortgage banker. So it's going to be a quite exciting time. You're gonna see me on the telephone with homeowners, sometimes live, talking between me, them, and their bank. We're gonna ask also that some of our shows will be recorded for training purposes, and also we will get waivers from homeowners to make sure that their privacy is not invaded in no form, fashion, or way. So welcome to my world. It's going to be a very, very exciting time. I want you to get your pads out. I want you to put your coffee pot on or your teapot, and I'm going to go over a lot of things with you to show you exactly how to get a modification. The first thing, what I would like to talk about, what exactly is a modification? Okay, the modification arise. There was a bank called IndyMac Bank. Now they are named One West Bank. Sheila Blair, which is the chairwoman of the FDIC, the Federal Depository Insurance Commission, that basically control all of banking and the buying of banking and the selling of different banks, and making sure that the consumers and all the regulatory policies are followed. Sheila Blair, back in 2003 up until 2006, they started a program at IndyMac Bank, and they started modifying loans. They were one of the first banks in the United States to start the modification program. They call it a workout program. This is before they even had the HAMP program. The banks were doing something called a traditional loan modification, or in-house program that the bank offered themselves. This is where a group of guys, they sit in a room, they say, okay guys, we got a lot of homeowners who are upside down, who are 60 days or more late on their mortgage payment, and we have to come up with some kind of workout program to keep them in their house. This is what the Treasury Department has put out through the performance service agreements that all the major lenders, all 283 lenders, signed with the Treasury Department to get TARP funds, which are Troubled Assets Release funds that the government gave all of the banks to help the homeowner. Exactly what a modification is in layman's term, is when you, the homeowner, contact your bank, and your bank offer you several different type of workout programs to lower your interest rate. Number 2, to extend your term. And number 3, in some cases, give principal reductions. That's where that when your house is upside down or you owe more on it than it's worth, you could receive a principal reduction, but that is all based on the investor. There are programs out there called the PRA program, Principal Reduction Alternative Program. There's programs, the Justice Department program. Back in May of 2012, there was one of the biggest bank settlements in history Okay, there was a $20 billion settlement. So $25 billion got allocated from 14 major lenders, starting with Bank of America all the way down to Wells Fargo. They were sued in a class action settlement, and if you go online, you can look under consent order, and you will find that. And you will be able to do research, and you will be able to see the guidelines that the Treasury Department and the Attorney Generals of all 49 states laid out for the banks to follow. So there's a lot of legislation to protect you. What we need to do as homeowners is get harder with the attorney generals to get them to be a little harder judicially on the banks to help you. When you show a willingness to work with your lender, to come to the table, to negotiate some type of workout program, your lender should bend over backwards to work with you. The first thing they should offer you that the Treasury Department says in their directives, the Treasury Department passed in the Financial Stability Act special directives, supplementary directives that we say we have to set aside some type of guidelines for the banks to follow. A lot of banks, they won't follow the guidelines. They just kind of like make it up as they go along. But there is a set of rules that the banks should adhere by. So what we try to do is show you those rules. So we're going to document everything that we say here with My World. We want to make sure we bring the right factual information to the homeowner, and that you can follow this on a daily basis, once or twice a day, and learn what you need to know. A workout program is simply when you sit down with your bank to get a lower interest rate, a term extension, or principal reduction to change the interest rate you got now. Treasury Department mandated that the payment is 6% less than what you are paying now, principal, interest, taxes, and insurance, or $500. It has to make sense. Why give a loan modification and the homeowner is going to fail the program? If you're going to lower their payment by $25 to $150, Mr. Bank of America, Mr. Wells Fargo, Mr. Chase, that's not going to do any good for anybody. That paper is not even worth that money what it's printed on. So let's start giving some type of modifications that's going to be effective to the homeowner. That's going to put more money in the homeowner pocket. When President Obama sit down with Timothy Geithner in the Treasury Department and heard his plan of the Making Home Affordable program and all the help it could offer, it could have offered millions of people, but a lot of the banks, they bottlenecked it. They made sure that a lot of these programs didn't get out to the homeowners in time, and they made it impossible when homeowners have to send documents over 15, 20, 30 times. There's homeowners that's been trying to modify home loans for 4 years. That should go in the Guinness Books of World Records. Can you check on that, Mr. Shadi Abraham, to see if there's a record for the longest loan mod? No, that's just a joke. Okay, let me get back to being serious. So that's exactly what a loan mod is. So we will go over different aspects of the modification process, and we will be able to do a few things and show you what we would like to do to make sure that you yourself can be educated and know exactly what to do. One of the next things what we are doing in another class, we will give you an explanation of who qualifies exactly for a modification. There's hundreds and hundreds and thousands of homeowners every day that submit all of their documentations to the lender, and guess what? They don't qualify. You know, you're wasting your time. 2 months, 3 months later, the lender has a software where they enter all your information, they ask you particular questions, and they can tell if you qualify for the Making Home Affordable program or for a traditional modification program with your lender, with your bank, or you may not qualify. You may be what they call underextended, where you can't really afford the home even if they modify the loan. by giving you a principal reduction, a term extension, or a interest rate reduction. This is called the waterfall effect. Interest rate, term extension, principal reduction. That's called the waterfall effect by the Treasury Department of Banking. The banks have to use one of these three components to bring you down to 31% housing ratio. If they lower your interest rate, the floor limit is 2% for modification, or if they take you from a 30-year to a 40-year, or if they cut $25,000, $50,000, or $100,000 in principal off your house, their job is to take you to 31% housing ratio. So what we're going to do right now, I'm going to let you digest that, and I'm going to put something on the screen so we can go over this again. We're going to